Are you ready to dive into one of the biggest decisions when it comes to investing in mutual funds? Today, we are comparing two of the most well-known and respected names in the investment world, Vanguard and Fidelity. Whether you're looking for the best money market funds, retirement funds, or simply trying to understand how year-end distributions could impact your portfolio, this video will break it all down for you. Let's start with Fidelity Mutual Funds. When you invest with Fidelity, you are tapping into a global network of nearly 400 research professionals and one of the largest research departments in the industry. As of 2024, Fidelity manages over $619 billion in US equity assets alone, with a wide range of mutual funds covering everything from domestic equity to specialized sectors. Fidelity gives you access to funds that can help you achieve your strategic investment goals. Some of the top performing Fidelity domestic equity funds include the Fidelity Blue Chip Value Fund, FBCVX, and Fidelity Low Price Stock Fund, FLPSX. These funds offer exposure to some of the most successful and innovative companies across various sectors. On the other hand, Vanguard has built a reputation as low-cost asset manager, overseeing more than $7 trillion in assets. Known for their simple, reliable strategies, Vanguard Index Fund have long been a go-to choice for long-term investors. If you're looking to build a diversified portfolio, Vanguard offers a range of top-rated mutual funds and ETFs, such as Vanguard 500 Index Fund VFIAX and the Vanguard Total Stock Market Index Fund VTSAX. Vanguard's low expense ratio, often below 0.10%, allows investors to keep more of their return, which is the key for long-term growth. Now let's talk about performance. Fidelity is known for its actively managed funds, where fund managers use their research and expertise to seek out the best opportunities. Funds like the Fidelity Contra Fund, FCNTX, and the Fidelity Magellan Fund, FMAGX, are legendary for their strong returns over the years. In fact, Fidelity's Contra Fund has averaged return of around 15.48% over the last 5 years, which is impressive. But active management comes at a cost. Fidelity's expense ratio are generally higher than Vanguard's, often ranging from 0.60% to over 1%. That said, if you're willing to pay for the expertise, Fidelity's actively managed funds can offer significant upside. Vanguard, however, is synonymous with passive investing, where funds are designed to track a specific market index rather than outperform it. Vanguard's S&P 500 Index Fund VOO, for example, has consistently delivered returns in line with the market. Over the past 5 years, it has averaged a 15.92% return, similar to the S&P 500 itself, and with an expense ratio of just 0.03%. You're paying very little for the exposure to 500 of the largest US companies. But how do these funds stack up when it comes to retirement? Both Fidelity and Vanguard offer excellent choices for retirement savings. Fidelity's Growth and Income Portfolio FGRIX and Fidelity Equity Dividend Income Fund FEQIX provide a balanced approach to growth and stability, making them solid options for retirement accounts like IRAs or 401ks. Fidelity also offers a wide range of target date funds such as the Fidelity Freedom 2030 Fund FFFEX, which automatically adjust your investment mix as you approach retirement. Vanguard, on the other hand, is known for its target retirement funds such as the Vanguard Target Retirement 2030 Fund VTHRX. These funds are designed to gradually shift from stocks to bonds as you near retirement, providing a hands-off approach to retirement planning. With Vanguard's low expense ratios and passive strategy, these funds are a favorite among long-term retirement investors. Now let's not forget about the capital gain distributions and how they can affect your returns. At year-end, both Fidelity and Vanguard distribute capital gains to investors, which can have tax implications. For example, in 2024, Fidelity's capital gain distribution estimates were provided for over 500 funds. These distributions are required by law for mutual funds, but they can impact your taxable income if you hold these funds in a taxable account. It's important to plan for these distributions as they can sometimes be significant. If you're investing in a taxable account, buying a fund just before a large distribution could result in a hefty tax bill, which is why many investors wait until after distributions are made. When it comes to ease of use, both Fidelity and Vanguard offer robust online platforms and mobile apps. However, Fidelity often gets the edge for its user-friendly interface and more advanced tools for tracking performance, making trades, and managing your investments. Vanguard, while offering a simpler platform, is still incredibly effective for long-term investors who prioritize low fees and steady growth. So how do you choose between Fidelity and Vanguard? It really depends on your investment style and financial goals. If you're looking for actively managed funds with the potential for higher returns and don't mind paying a bit more in fees, Fidelity might be the way to go. On the other hand, if you're looking for a low-cost, long-term strategy, Vanguard's index funds are hard to beat. Both offer excellent retirement options and both provide a variety of mutual funds and ETFs to suit different investment needs. In the end, whether you choose Vanguard or Fidelity, you are aligning yourself with two of the biggest names in the investment world, with Vanguard's low-cost index fund and Fidelity's actively managed growth funds. The choice comes down to your personal investment preferences and long-term financial goals. Thanks for tuning in to this detailed comparison of Fidelity and Vanguard mutual funds.